Hello and welcome back to Crypto Saver. So today is a big day for the cryptocurrency community because within a couple hours now, we are going to have a Bitcoin ETF hitting the market, stock market. And the ETF will trade under the ticker BITO. And everyone's been looking forward towards it because there hasn't been an easy way to invest into Bitcoin within the stock market. If you wanted to buy Bitcoin, you had to go into the cryptocurrency market to do so. But in this video, we're going to discuss as to why buying BITO as a way to speculate on the future movement of Bitcoin is actually the worst way that you can possibly do it. Now, to better understand how this Bitcoin ETF differs from, let's say, SPY, which tracks the S&P 500, let's first look and see what SPY really does. So when you buy a share of SPY, what actually happens in the back end is that a portion of your money is used to buy a portion of Apple, a portion of Google, a portion of Facebook, a portion of Tesla, a portion of all the 500 holdings within the S&P 500. But when it comes to BITO, if you buy into this ETF, your money will not be used to buy any Bitcoins whatsoever. Instead, what the ETF will do is that they're buying exposure to Bitcoin by buying Bitcoin future contracts. Now, that might be new to some people, so I'm going to try to break this down and help you better understand what it means to actually buy products on the futures market. To get going into that, let's first understand what is a spot price. So when you're buying Bitcoin on Coinbase, for example, or in Gemini, whatever it might be, you're always looking at the spot price. You're always looking to see what it's being traded at that moment, and you could buy it at that moment. But when it comes to the futures market, hence the word futures, you can never buy it at the spot price. Instead, you're buying it at either buying it at a premium or at a discount. And that determines as to whether or not the stock is in a contango or if the stock is in backwardation. Now, to help kind of explain that, let's look at oil. I'm going to bring up the current future contracts for oil. Now, if you wanted to speculate on the price of oil and you wanted to buy it on the futures market, you can kind of see right now, pay attention to the column that says days. That's days to expiration for that futures contract. Now, if you hold, let's say you buy a contract of CL, crude oil, and you hold it to expiration, well, you actually would have to take delivery of all that oil if you were to do so. Obviously, you could also trade out of the contract before expiration, but either way, there is an expiration date to futures. So either you actually want to take delivery of it or you want to actually just trade out of it before expiration. Now, as we look down the days column, also pay attention to the column where we see last, because that tells us basically like the last price that this contract was traded at. And you can kind of see as we go down the list and the contracts are further and further out, the price is cheaper and cheaper. And this is priced at per gallon. So right now, the active contract, which expires in 31 days, is trading at 81.83. But if you look at the one that's 126 days from now, it's being traded at 79.13. Now, this tells us that the market and traders are expecting that the demand for oil to come down over the coming 3 or 4 months. That's kind of baked in. And that's one thing to keep in mind when you are trading products, commodities on the futures market. It sometimes might seem simple where, for those of you who are in the stock market, like trading VIX, right? There's VIX on the futures market. And when you see VIX really low, right? VIX is simply a gauge of fear within the market, and it tends to be somewhat mean reversing. Well, you get it. So when VIX is, let's say, at 13, 14, it seems like a no-brainer. Let me just buy VIX because it's probably going to go up to, let's say, 16, 17, right? If that's where it's been for the last few years or so. But the market kind of is pricing that in already. And in this case, we could see that oil is actually going through backwardation, where lower prices are being priced in the future. Now, if you look at Bitcoin, let's look at Bitcoin futures right now. What I have up top is when I took the screenshot a couple hours ago, the spot price came from CoinDesk. And then below that, we have a screenshot from Thinkorswim, which is simply a trading platform by Ameritrade. It's what I personally use for the stock market. You can see what the actual future contracts are for Bitcoin. Now, if you look at the active contract right now, which expires in 10 days from now, you can see that the last price is 62,735, which is almost $500 above the actual spot price, the price you could buy Bitcoin for on Coinbase, let's say. That's a 0.8% difference between the spot price and the active contract for Bitcoin. Now, why does that matter? Well, as that contract that expires in 10 days, as it approaches expiration, this gap in between, the spread in between the spot price and the future contract will begin to lessen and lessen to the point that on the last day of trading for this futures contract, it should actually be trading right where the spot price is. That makes sense. So if I were to buy this Bitcoin future contract right now, just to speculate on Bitcoin, I can expect that over the next 10 days, I will lose about 0.8% of the value on this contract simply because of Contango, simply because the market is already expecting the price of Bitcoin to be going up. And here's the thing, this ETF, this is how they're getting you exposure to Bitcoin by constantly buying these future contracts of Bitcoin over and over again. And ever since the Bitcoin futures has existed, there's always been an issue with Contango. There's always been an issue with the fact that future prices of Bitcoin futures are always trading at a higher level than the current spot price. Maybe in the future, there will be a time where there'll be backwardation, where you could actually look at the Bitcoin futures contracts and notice that the future price is actually pricing in lower levels. But as it stands right now, it's pricing in higher levels. So if you were to buy this ETF, you will be underperforming simply going in and buying Bitcoin on your favorite crypto exchange. If we actually look just one line under the screenshot for the contracts that are expiring in 38 days, and if we take those numbers, the last price of that contract versus what the spot price was, again, when I took the screenshot all at the same time, there's actually almost a 1.5% difference. So again, if you were to buy that contract, you would expect that over the course of the next 38 days, you would lose about 1.5%. You could just think about it like this: like, here's a futures contract, the price of it, here's a spot price, and as we approach expiration, the futures contract, that price needs to come down slowly and slowly until it hits the spot price, which is at the day of expiration. So it comes in gradually. So these type of products, whether you're trading the Bitcoin futures directly yourself or you're buying the ETF, these are not things that you should be buying as a long-term hold, because over the course of a year, 2 years, 3 years, you will be vastly underperforming simply buying Bitcoin yourself, because this is going to be occurring month after month after month. The spread difference in between, you're going to be eating up that cost yourself. So that's a big thing to keep in mind. If you want to buy this ETF, sure, it's an easy way. It's a simple and an easy way for you to speculate on the price of Bitcoin. If you feel like maybe over the next couple of days, couple hours, it's going to do something here or there, sure, it's simple for getting that done. But if you plan to buy and hold, it's simply not the right idea. And just to run through a few little issues here too, throughout all of this. Now, as I said before, with oil, if you were to hold it to expiration, you would have to take delivery of it. But Bitcoin futures are not settled based on delivery of the commodity. Meaning, if you were to hold that Bitcoin contract on the futures market to expiration as a buyer, you're not forced the seller is not forced to provide you that Bitcoin at that price, at that moment. Instead, these type of trades for Bitcoin, they're settled on cash. So simply the difference, the profit and loss between when they sold you the contract, when you bought it, and so on. So throughout all the speculation, throughout all the money that could be going into BITO, none of this will really affect the price of Bitcoin, because at the end of the day, Bitcoin is not being purchased through any of this. On the flip side of SPY, if you're throwing money into SPY and you're buying shares of SPY for your retirement account, you are actually providing that buffer. You're creating that buying pressure for Apple, for Facebook, for the lower caps within the S&P 500. But with these futures, no Bitcoin is being purchased whatsoever. And I can view that as a con for the Bitcoin community, though, because there will be a lot of people that, let's say, do want to invest into Bitcoin, and maybe some of them are learning or trying to transition to using Coinbase, Gemini, or other exchanges. But if they see that there's an easy way for them to get exposure through the stock market, they might just do that, and you'll have money going into the actual ETF. So all this money that could have actually gone directly into buying Bitcoin on the actual crypto exchanges is instead going to be going into these ETFs, which will not actually affect the price of Bitcoin. The supply, the demand, the buying pressure within the ETF will have no effect, truth be said, on the actual commodity, which is Bitcoin. Now, if you like this video so far, please give me a thumbs up. I appreciate it. And if you have any questions, just leave them in the description below, and subscribe if you do like this sort of content. And for those of you that are still watching, I'm going to talk about a little interesting strategy here that I know Wallstreet has been doing for some time. Bloomberg ran an article on this a few months ago, and it's going back to this little difference that we have. So right now that we know that the current active contract for Bitcoin is trading at around 0.8% premium versus the spot price. That can actually be guaranteed profits for people that are willing to arbitrage this opportunity. So how would you do this? And how is Wallstreet doing it? Well, you could go over to Coinbase. Let's say in this moment when I took the screenshot, you went over to Coinbase. You bought one Bitcoin for $62,237. At the same time, you also shorted one contract of Bitcoin in the futures market at $62,735. You have no exposure to any price movements at this point, right? If Bitcoin goes up 1%, you would gain 1% on the Bitcoin that you have in Coinbase, let's say, and you'd lose 1% on the Bitcoin that you shorted in the futures market. But because of the premium that exists there and the fact that the futures contract price will converge to the spot price towards the end of expiration, then over those days, you will slowly be eking out that gain to the point that come expiration date, you're able to pocket 0.8%, essentially guaranteed, because you have no exposure to any price movement because you're long as much as you are short. So you're simply making a play on that spread in between. Now, if that does sound interesting to you, I can make a video on this. Just let me know in the comments if you kind of want to see how this could be done in real life, how you yourself could be doing it. There used to be a time, I know earlier this year, the difference used to be considerably greater, right? So right now we're looking at let's say for 38 days away, it's about 1.5%. You can basically lock in 1.5% of guaranteed of gains there. It used to be considerably higher earlier this year, as much as I would say 4 or 5% monthly that you could simply secure with this type of strategy. But naturally, as more people learn about it, as more money flowing into this type of idea, the profits start coming down, where there's still a difference here. And it's natural to understand why it comes down, because to do the strategy, you have to be buying the actual commodity and you have to be selling the futures contract. You can't reverse that. Yeah, you can't be shorting it in the crypto market and buying it on the futures market, then the strategy doesn't work. So you have to be buying the actual commodity and shorting the actual futures. If you're shorting the actual futures, what are you actually doing? You're driving down the price of Bitcoin in the futures market. And if you're driving down that price, then you're actually bringing it closer down to the spot price, which is why the strategy is not as profitable as it was earlier this year, but it's still there to the point that in 10 days, you can lock in a 0.8% profit, which, I mean, it is a substantial amount of money, especially because, I mean, it is pretty much risk-free at this point. And that's basically what I wanted to cover. And it's still gonna be a big day. So the market actually just opened up about a minute ago. It's gonna be interesting to see how it trades. But as I said, it's unfortunate that all the buying pressure with this ETF will not really have a direct effect on the price of Bitcoin as the commodity. Other than that, thank you for listening. And yeah, once again, if you like this video, just give me a thumbs up and have a great day. Thank you.